With all of the current health situation globally, every industry is assessing the impact on their sector. And of course, the property market is absolutely no different. Joining us to discuss this is our old friend Evan Lucas from Invest Smart. Evan, great to see you again. There have been so many changes, even in the last week since we last spoke to you. I mean, how do you view property now?
Look, last week when we discussed this, it was sort of coming to a level where the nervousness was all around one thing. A was confidence and B was employment. And I think over the week, now that you've actually seen the government itself basically admit that they expect the unemployment rate to increase. We've seen the Reserve Bank of Australia also very much say that they expect unemployment to increase. That confidence side will be under real pressure. So that's what is changing, and it is going to change almost every day for the next several months.
It certainly feels that way. I mean, every day we're getting new announcements, new stimulus, the RBA cutting emergency rates on Thursday. The banks was an interesting one for me, Evan, because they said that they're pausing mortgages. And of course, we're seeing some variable and fixed rates now below 2.5%. Can that help?
It can. Again, the other thing that came out this week from the banks as well is, yes, they are predicting pause, deferments of up to 3 to 6 months, depending on which institution you're with. As you already alluded to, you've seen some rates even below for a starting point of 2.29%. All very helpful. I can't deny where that currently sits. It is certainly about keeping the flow of credit, because that's what it is, that's what a home loan is, to the consumer. The catch is the other side, though. Does this, even with this incredibly cheap amount of money that's being offered by the banks, still see a scenario where demand really falls away? And that's the real question that, again, I actually will put my hand up and say, we don't know. Because, again, this could be seen as an opportunity, but I would caveat that is that the difference between 7 days ago when we sat down and talked about it and where we are today and what could happen in 7 days' time is that if we see more and more pressure being put on the economy, more and more people having to not only work from home but possibly find themselves out of work, it won't matter how cheap is being offered by the banks, because the ability to buy a home will get harder and harder even with those low rates, because the bank still has to assess you on credit. They still have to assess you on your future ability to pay your mortgage, even with the current scenario. And that is going to make it also harder, and their cheaper rates. It doesn't matter. It's all around confidence and your ability to keep employed.
Couple of very hard questions coming at you now, Evan. I mean, in terms of if we see the unemployment rate rise as it is expected to do, how much could that dig into national property prices after the run-up that we've seen, do you think?
So, okay, I'm going to answer that in a bit of a step process. So first and foremost, property market is different to almost any other market. And the reason I say that is that unlike an equity market or something like that, where supply and demand is pretty constant, supply is controlled by you and I or those that actually own a property. So if they believe that the property price is going to fall quite dramatically, they'll just hold on to it. But in answering your question, it is going to fall because the amount of actual competition on the demand side is clearly going to fall away. Investors are clearly going to be reassessing of whether or not they should be putting money up in this current environment. You've also even got those that are looking for a new home that are going to ask the question, should we wait now until this sort of passes and look through it? It is going to therefore put downward pressure on demand. And when you have that simple economics, even with supply where it currently sits, it will mean that prices will probably start to fall. And I suspect that maybe not even last weekend, 2 weeks ago, might have been the top of the market for this cycle. Don't forget, we are actually at the same level, if not slightly above, the peak of the market from 2017. And that was the absolute peak. So it is a very red hot market. You've been hearing that for a while. Whether or not the coronavirus was the reason to pull it back is up for debate. But it will ease, and that is something I can say fairly confidently. It is going to ease. People are not going to have the kind of level of demand they had 2 weeks ago.
So, Evan, the multi-million-dollar question then, it sounds like you'd be waiting if it were your money. Is that true? And if so, how long would you be waiting here?
Yeah, okay, so my money, yes, I am. But in terms of those out there, I understand it's a completely different point of view. How long to wait? Again, the other thing we've seen with this whole scenario is that is a very unknown question now. This could be a 6-month problem. As you can hear from some health experts, it could be an 18-month problem. So in terms of time, I don't know, and I think that's the best answer I can give you.
Mate, thank you so much. Very uncertain times. Evan Lucas, thank you very much.